The Dow losing more than 3,000 points last week as coronavirus fears hit the markets. But some stocks are still performing well compared to the broader market as people start to work from home due to the virus. Joining us for a look at where some of the safe havens might be in stay-at-home stocks, Mark Mahaney, lead internet analyst at RBC Capital Markets. And Mark, I guess I'll start off by saying, do you buy into the premise that there'll be enough change in consumer behavior that it gives a tailwind to certain types of internet stocks and other stay-at-home stocks?
Okay. Well, good morning, Mike. I hope not, but to the extent that there are assets out there in the internet space that would benefit from people cocooning, people staying in for entertainment, you know, there's a couple of names that come to mind. The most obvious is Netflix. I also think social media stocks like Facebook, which would be sort of a form of communication, connection, a little bit of entertainment and information. I think that would be an obvious beneficiary as well. There's a few other social media stocks, maybe Twitter as a news service, maybe a Snapchat, and then maybe a music name like a Spotify. All of those would kind of fall into the cocooning beneficiary camp.
Now, Netflix has certainly held up. Essentially, it's retained its value through this whole sell-off. And I guess as somebody who covers it, would you really think that this would be a driver of incremental new subscriptions? Or is it just essentially people saying, look, at least I'm buying something that's not going to be disadvantaged by what's going on?
I think it's probably the latter more than the first. At least you'd probably stem churn. This is if you're uncertain about your ability to find other entertainment, live entertainment options in the next month or two, you're probably going to be less likely to churn at this particular point, irregardless of the content slate. I think that would be the win, the small win for Netflix in this environment.
In terms of what have been tagged as potential losers, Uber, Lyft have been weak. Everything's been weak, but there's a story out there that just going out less is going to hurt volumes. And would you see that as something that's going to last for a little while, or is the pullback in Uber something worth trying to play?
Yeah. So if I switch and think about the internet companies that we cover that are most exposed on the negative side, Alibaba's at the top of the list. The travel companies like Booking and Expedia, both of which have warned pretty draconianly, disastrously, whatever the word is, about the March quarter results, maybe going into the June quarter. Amazon and eBay, companies that have supply chains into China, and then Uber and Lyft. Uber is, both of these companies get about 15% of their rides from airports, either people going to airports or people coming. So clearly they're a negative derivative of anything that shuts down travel. A little bit of a hedge that Uber would have is, however, on the Uber Eats side, if we're going to cocoon and be unwilling to go out in the public areas, perhaps the food delivery business of Uber will provide it a little bit of a hedge against that airport travel exposure.
And Mark, I guess, while we have you here, do you cover Twitter, and do you have a thought on this kind of activist move that we're hearing about this morning?
I don't think it's terribly surprising. Elliot's been relatively active in the internet space. I look at what they've been involved with Akamai and in eBay and in Twitter. If you were going to get involved in Twitter and you were going to be concerned about product changes, or they've always had this. I don't want to say it was dysfunctional, but it's an unusual management approach. So that's a good reason for an activist to at least look at this. And then they did have something of a misstep. Our concern last year was that the company was over-earning, that they weren't putting enough into R&D, product development, and the glitches that they had seem to confirm that. So somebody coming in from the outside, pressuring them to get a management team that's more focused on that full time. It's an interesting pitch. It's not irrational.
It's not irrational. I guess, what do you think specifically, aside from getting a full-time CEO, if that is in fact what Elliot is trying to say, needs to be done at Twitter right now? General reinvestment in the product, is that the idea?
Yeah, I think so. Look, we know we've had product glitches. We know this is an asset that's built up and had very nice growth in users over the last several years. We've had double-digit growth in daily users over the last 2 years. So the growth rate's been impressive. And the problem's really been on the advertising side, more than on the customer side. They've done a lot of things to improve trust and security at the company and to make the service just a little bit more intuitive for all of those of us who use Twitter all the time. It's very intuitive, but for the next couple of 100 million users, the service needs to be more intuitive. So there's a few more changes they could make on the consumer facing side. But the big issues have been on the advertising facing side, and that's just a matter of of R&D development, product development improvements. And I don't know where the blame lies, but some of that has to lie with the CEO.
Yeah. And just you mentioned that the general social media space, who knows, might be able to get some traction here. I wonder about this other element of this sell-off, which is not necessarily just coronavirus and the impact, but you had some crowded positioning in some of the very big tech stocks potentially. Some of that's being unwound. Where are we in that process as far as you can tell through clients and checking out how these stocks are acting?
So, Mike, when you say crowding, I think, relatively fully valued stocks.
Yeah.
And in that large cap internet space, most of these names were at pretty reasonable valuations. There weren't really any dramatically dislocated stocks. There was one at the beginning of 19. I'd argue that was Facebook. And I think there was one in particular at the beginning of 20. And I'd argue that was Uber. And I think there's still a lot of upside in that stock. It's our #1 pick. But there's no question going into this, most of these valuations were pretty reasonable. There was nobody who was trading at a material discount to their averages.